Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today I'm going to be analyzing Hasbro stock. As always, this isn't individual investing advice. I'm just sharing how I personally analyze these stocks and what I think about them. This one came in by request. If you have a request of a stock you would like me to analyze, just drop it down in the comments section of one of my videos. I'll get it on the whiteboard behind me and eventually I will make a video. If it's in the S&P 500, I usually post those on YouTube for free, and if it's not, I post those over on Patreon, which is $5 a month. And then I also post everything on the Cyclical Investors Club investing group on Seeking Alpha, and if you join Patreon, you get a big discount there. And that group has it's basically like a full investing service. So you get all my spreadsheets, you can chat with me pretty much any time of the day. I have tons of articles there. And it's just a great group of people over there. So those links will be down in the description. With that, let's get into Hasbro. So I think just the first thing I always check is past writings or past videos that I've done. I don't think I've ever written on Hasbro before. And part of the reason why I will show you in just a minute. But the first thing I like to check is the historical earnings history, especially the cyclicality. So we can see that from 2003 until about, this was kind of an unusual bump, so I would say until about 2018, we have a pretty steady rising earnings situation for Hasbro. And then, since then, things have gotten rockier. So this looks pretty good. You can kind of understand why a person would have invested along, especially maybe in here. You have a pretty low PE ratio. You have pretty okay earnings growth. I think all the good years are not listed on the graph, but shorten it up and let's just see what somebody would have been looking at. So yeah, earnings wasn't great. So just kind of inflation level earnings growth by this point. Every now and then they have a pretty big good year. Usually it's followed by a slow year, but you have a little bit of growth and you had a relatively low PE ratio to go along with it. So that looks like it'd be fairly valued to me. 2014 was growth picked up. That's probably getting a little expensive here. And then when growth really got fast, then the market really got excited. It wasn't like extreme compared to some businesses, but given their history, if you were to average that out, it never looked super cheap, I would say. That's how I would describe it. So that's probably why I never have written on it. It also didn't look like crazy expensive either, which is another reason why I never covered it before. I do track it, probably because I think it's in the S&P 500. I usually track most S&P 500 stocks. So the earnings history looks okay. They have some down years, but they didn't, until these last 2 years, they didn't have any really steep down years. So hasn't been traditionally super cyclical, which is kind of important because now that they are having these really rough years, it's probably not due to cyclicality. It's due to probably something to do with the business, which is worse than if it was just a cyclical downturn and it's normal and then you would expect them to bounce back. So that's kind of important to know. Let's think of the thing we should check next. Well, I picked this time period. This is usually where I start with most stocks nowadays because often they've changed from, if you go all the way back to 2006, it's just such a long time ago that things have developed in a lot of these businesses. So even though we haven't had like a real normal recession, 2020 was a weird one. This at least gives you, like 9 years, 8 or 9 years usually. Pretty soon we'll be looking into a full decade. So it's a pretty decent stretch and closer to modern today than if we go back another decade when things were totally different and we didn't even have smartphones. So looking at this, you can see that things are pretty choppy and the general trend is pretty weak for earnings growth. But they are there, so Fastgrass has them at 3% earnings growth. It usually measures from point to point, and I don't know if it's counting this point yet, so it's probably from here to here. That looks like about 3%. Oh, actually, I think it measures the years that haven't occurred yet. So if we shrink it down to actually this year, it's probably going to be worse. -4. Okay, so this is more like it. But some of these years, they've had quite a bit of excess earnings above that. So I think if you average this out, I'll look at what I have here in a minute. It might be a little bit better than that. But basically, when you consider there's been 20% inflation, you're not getting any earnings here. No earnings growth. You're getting earnings, just no earnings growth. PE doesn't look great, but earnings are expected to grow next year. All right, so let's look at the numbers here, and I'll tell you what I care about the most. So now when I look at these, so I actually have a pretty generous earnings growth rate at 5.2%. So I don't think I'm being unfair here. But the thing that would make me just avoid this stock, let me move my face just a little bit here. So this is 3-year cumulative revenue growth. So from 3 years ago measured to now, revenues have actually declined. So when I see that in a stock that isn't very cyclical, and when we aren't in a clear recession downturn for their industry, there's not some super clear explanation for it. If this is negative, that's enough for me to sell a stock, even if I owned it already. If it's under like 10, that might stop me from buying it. I really want revenues over a 3-year period. Revenues can vary, from year to year, but if you go 3 years and you're lower, that's usually not boding well for your growth over the longer term. Now, if this were to change and they started to turn things around, then I would look at it again. So this would be immediate not buy. It would be a sell for me immediately, just based on that, and a little bit of thinking for the context of it. So, but if we want to be a little more, but I don't invest in turnarounds and things either. So if it's not a normal cyclical downturn that I can count on it coming back, I would say, so that is a type of turnaround, but that's a cyclical one. Those are okay. The ones that are not cyclical ones are not okay for me. So I try to not invest in those. But we do see the analysts are expecting $3.87 for next year for earnings, which, if they're correct, would be a sort of recovery at least. But what I want to show you here is, so this year they're looking at 277. So if we change that to 387 for next year, and we look forward a little bit, that changes this 10-year expectation for the return for the business returns to be 5.52%. So that's right where the S&P 500 is basically right now. So I would say at the price right now, analysts or investors are pricing in next year's earnings already, as far as I can tell. And that's basically spot on with the S&P 500. So this is already priced into the stock. And at that price, it would just be a hold. It's just like average, kind of like the rest of the market. So what you kind of want to ask yourself is, do I want to own Hasbro, which also does have a lot of debt? If you look down here at the difference between the market cap and the total enterprise value. So do I want to buy a company that doesn't have much growth, if any, that has quite a bit of debt, that's priced about the same as the S&P 500, or would I just rather go buy something that I know is a better business that's priced about the same, and put my money there, or just place it on the S&P 500 and spread your bet to 499 other companies? So for me, that just makes more sense in a situation like this, unless a person is really playing it for the turnaround potential, and that's a totally different thing. You're gonna have to do you're gonna have to do deeper research than what I'm doing here, and maybe if you're good at it, you can do it, but I'm not good at that, so that's not what I do. Let's see what else. One thing I would say is they have a pretty high dividend yield, and I'm sure that some people are going to be attracted to that. If we assume Hasbro has 5%, now I think my 5% growth rate is probably generous, but if we assume that they can grow 5% a year, then probably you're probably more like a 7% dividend yield if you're looking at this as like a potential dividend stock. And if they didn't have the debt, it would be probably attractive here as a dividend stock. But you're basically, as a dividend shareholder, you're gonna be competing with the lenders, with the bondholders, and it's kind of teetering right on the edge of who's going to kind of win this, the future of the company, who's going to own it, basically the shareholders or the lenders. And I would say you don't know that yet, so that's unclear to me. It might work out if they, again, it kind of depends on a turnaround. If you assume that they turn this thing around and you buy it when it has almost a 6% dividend yield, and then they start growing earnings, you're going to do really good over the long term. But I'm not going to make that kind of bet personally. I'm going to look at the history and say that's probably likely. Usually about 80% of the time, the history is a good guide. But if you did deeper research, if they have new stuff coming, which I haven't looked at, and you think, oh, that's going to work, that would be the only way I'd be really buying into this. All right. If you thought this was useful, hit the subscribe button and the like button. And if you have a request, drop it in the comments. And I will see you guys in the next video. Later.